Tesla's stock is going to crash. They missed their delivery estimates. AI Day was somewhat of a disappointment in some people's opinions. And we're in a uncertain macro environment with rising rates, and that's going to make cars less affordable. So they may not be able to have the same type of demand that they've had in the past in the next year or few years. So I'm coming out and saying it. Tesla's stock is going to crash. Why am I saying that? I'm saying that because multiple times in its history, since 2011, since it's been public, the stock has dropped more than 30%. And it's even dropped more than 50% once. After COVID happened in March of 2020, the stock was down 41% from its highs. Right now, this is before the market even opens, the stock is down 35% from its highs. And right now, we can see it's down another 4% this morning. So I'm coming out and saying it. The stock is going to crash. If you look back at any successful stock that has made life-changing returns, the stock has crashed 30%, 50%, even 60%, usually multiple times in its history. And look at this. Even with all those crashes I just showed you since 2011, Tesla is up 16,550%. So I'm going to say it again. The stock is going to crash. At some point, it's going to drop 30%, 40%, 50%. And if you can't handle that volatility, if Tesla missing delivery estimates by 20,000 cars makes you stressed out or thinking about selling the stock, then Tesla is not a stock for you to own. And that is 100% okay, because every investor has to know how they're comfortable investing and then invest money accordingly. I will not be selling any of my Tesla shares, but I'm also not going to be scurrying and rushing to buy more. Why? Well, if the stock is down 5% today and I wasn't rushing to buy more last week, why am I going to change my whole strategy and rush to buy more just because the stock is down 4 or 5%? That's how you get hurt. I'm going to continue my plan. I have my percentages set in M1 in my portfolio. As I put money in my portfolio, it is going to add money to the stocks that aren't as large as they should be according to my target size position. So example, my target size position for Bill.com is 7%. It's at 4.6%. So the next money I add is likely going to go towards building up these positions to get them towards 7% of the portfolio. That keeps me from rushing into Tesla when they miss delivery estimates by 20,000, the stock's down 4%. But what it'll do is over time, if that becomes a smaller position than my 7% target size, or if I decide I think it should be a little bit higher than that, then it will get money added to it over time. That's how I protect myself from my own emotions and stop worrying about selling stocks based off minor changes, a minor earnings miss, a minor delivery miss, or whatever. It just helps me emotionally. Let's jump into this. I don't think we should be concerned about this delivery situation. I think if we're invested in Tesla, my thesis is that they are going to continue being a market leader in EVs. They're going to, I think this humanoid robot that they talked about is a real potential revenue driver in 5 to 10 years. They're in solar and battery backup. And then I think a big thing that a lot of people aren't talking about is that they're going to have some type of software subscription revenue that is a lot higher margin, a lot more profitable than selling just vehicles. And this is why I think Tesla deserves a premium valuation, and because of their pace of innovation and the lead that they have in data and self-driving and all of this stuff, this is why I think they deserve a premium valuation to traditional auto manufacturers. I will continue to monitor the stock. If they continue to miss estimates, if they drastically miss estimates, then I will obviously reconsider my thesis. But missing by 20,000 when factories were shut down, which hurts their ability to produce and deliver vehicles, when all of that stuff has happened and it's just one single quarter, not a reason to stress over a stock, in my opinion. Okay, so let's talk about this. It was down 5% according to this article. JP Morgan came out with a bearish view following the deliveries update. They remain wary on valuation and continue to see large downside, minus 42%. So there you go. They think the stock could fall 42% from here to our price target, including the potential for multiple compression amidst rising competition and less distinction versus traditional automakers. However, there were plenty of bulls to make up for their pessimism. Another analyst from Goldman Sachs said, "We believe the company remains well positioned to drive solid volumes and also margins free cash flow going forward, and the vehicles in transit issue is a mitigating factor for the Q3 delivery miss. And so what they're saying is that there's vehicles in transit that just weren't being able to be delivered, which hurt that delivery factor, and they think it's going to bounce back in Q4. So this Webbush securities analyst said Q4 performance will quickly put Q3 in the mirror with investors. Okay, we believe the unit setup into Q4 is very robust and could approach massive numbers that are in the 475K plus range. Street will be disappointed by the softer delivery number in Q3. That said, we view this more as a logistical speed bump rather than the start of a softer delivery trajectory. Okay, I don't know what's going to happen. I don't know if it will be a soft next year or whatever. And I'm going to get to why I'm okay with owning shares in just a second when I talk about 3 scenarios: bearish, bullish, and kind of a base case, or low, medium, high scenario that just give me confidence in the stock price over the long term. They also had their AI day, and I'll do probably a whole video on AI day and some of the updates, but they talked about this humanoid robot, right? And there really wasn't a whole lot other than that they already have one. They're only like 12 to 18 months into the program since it was mentioned. It wasn't walking, but it was standing on stage. It waved to the crowd and it raised its knees, okay? The idea behind this is that it's going to be a robot, an AI-powered robot with a 2.3 kilowatt hour battery pack, and that should last for a day's worth of work. All of this stuff really doesn't matter at this point. I mean, it's going to change so much by the time these things are actually released. The mass market robots will be initially tested handling simple jobs in car factories before being set free to perform real-world tasks. Elon Musk believes Tesla can bring Optimus to the market in 3 to 5 years for less than 20K. Okay, let's make that 5 to 10 years, right? Let's set realistic time expectations. Elon Musk's grand plan is that a mass market Optimus could bring a fundamental change in civilization by virtually ending poverty due to improved economic output. Okay, big ideas, right? No one believed in the supercharger network when it happened. No one believed in SpaceX. No one believed in their Starlink satellite system. No one has believed in anything Elon Musk has done, and he's eventually done them and actually been quite right. Okay, so I'm bullish on Elon Musk and bullish on Tesla just over a longer term than what they're saying, in these releases, right? Because things take a long time. Okay, they also updated on its autonomous driving software in the Dojo supercomputer that is being set up to train its in-house artificial intelligence. Notably, the Dojo development team showed images of a Cybertruck and semi running on Mars using stable diffusion made possible through Dojo. Elon Musk even teased that Tesla could sell compute time on a Dojo in a fashion similar to how AWS service turns up billions. Okay, so a lot of innovation going on there. All right, all of this comes down to you still have to buy a stock at a reasonable price, right? So what I've done is I've gone in and I've put a 10-year scenario in. That's a long time. I get it. People aren't going to like that. If you don't like it, that's fine. Don't buy the stock. I'm not telling anybody to buy the stock. I'm sharing why I own the stock. Revenue growth in the low scenario, 20%, mid 25, and high 30. Profit margin at 14%. Free cash flow margin at 16%. A PE, it's right now at 86, but down to 20, 25, and 30. And price free cash flow down from 119 to 25, 30, and 35. We want at least a 10% annualized return. Let's hit this and let's see what these are the prices we would be willing to buy shares at today if we believe these scenarios to be true over the next 10 years, right? I'm long Tesla, not selling any of my shares. I'm also not rushing to buy the stock. Let me know what you think in the comments.